Hello, YouTube. The S&P is only off by about 0.5% to birth a new bull market, which would be 20% off of our October low. So this today, meaning this weekend, we're going to go through and try to get prepared for why would we go into a bull market? Are we going to believe it, and what exactly what that means? So please stay tuned, and we're going to walk you through all of that this weekend. The saying a lot of people like to use is sell in May and go away, and then again add on come back in Labor Day, which means sell in May and come back in September. The saying I'm going to go through this weekend is prepare for May, meaning what if we do go into the bull? Whether you believe it or not, price is king. So again, prepare for May and be ready to go away. That's what I really want to focus on. Whether or not you want to be at the screen, I think you want to enjoy the summer, which means if we are off by about 0.5% to a new bull, something dramatic is happening. What is it? Well, funds are ignoring Wall Street's resilience, and they are the most bearish they have been since 2011. What that comes down to is the CFTC net short positioning, and we note here that they are at a level that has not been shorted since 2011. If we look here at the monthly chart for the S&P, oh man, that was like a time to buy. Yep, started printing higher highs and higher lows, and we were over both averages, and it went from about 100 to 400. Didn't happen in a straight line. Didn't happen without us climbing the wall of worry, but we got there. So what I think I want to focus on today is just making sure that we understand that if this time is different, we're going to look at the fundamentals, we're going to look at the technicals, but let's give you a very high level overview here by just looking at the chart. So let's actually remove a few things to make it even simpler. And here we're just going to note that we have two lines. We have a downtrend and we have an uptrend. So what does that mean? It means when we poke over the red line, we stop going down. And as long as we hold this green line, we're going up. So the thing I'm going to be watching for as we're going into the entire month of May is whether or not we repeat the same pattern from this month, meaning higher lows, higher highs, and over the previous monthly high. For last month, that was 409.7. For this month, it is 415.94. So if we're able to get above about 418, it means we are not only in bull market territory or that 5% off the highs we talked about. We're now making new 2023 highs. We're in a higher low, higher high over the previous monthly high with bull volume. And then additionally, we can also note that we look here to our Fibonacci numbers, which are math. So we look here to 398. We bounced off that last month. 414 we just claimed, and that is a 50% retracement. So why is a 50% retracement important? Well, it signifies the 50-yard line between the all-time high and our 52-week low, and we're right back to the middle, center field, which means we are at the area where neither team really has much of an edge, and we want to just make sure we pay attention to the price action. Price is king. So at a very high level, that's what we're looking at here. And this is fuel that has almost always led to more gains. If we have a look forward here to the S&P 500 E-mini futures, or ES1, what it shows us here is a volume profile on the right-hand side. And what we notice that after we chewed through this current bar at 4150, 4190 is like the last notable zone before we have a fairly frictionless move higher with a whole bunch of buyers who want to get out. This looks like it's going to be very painful. I'm going to ask you for a huge favor, please and thank you. If you could, please consider smashing that thumbs up and subscribing to the channel. I will thank you ahead of time because you guys are just such great people. Let's move forward. Something else people forget is that the full year has never been lower, meaning red on the year, when the S&P is up by more than 7% in the first quarter. We're now going into the third quarter where we are green. Let's have a look and see what that means. Oh, on a quarterly chart, we're actually putting in 3 in a row that are green, but we need to take out that 431 high to really have upside momentum to go back to our all-time high. So what this means is, historically, when we look here to every previous time, there's only once where we actually closed lower than we were. That was in 1987, where we actually closed lower than we were after the first quarter. But every other time, we've closed higher, and it's usually been dramatic, double-digit gains. So we can't forget about that. Other thing we want to keep in mind is that the reason why a lot of bears are quite pessimistic right now is because of GDP. But as we look here, this print came in yesterday morning, meaning Friday, April 28th, and it came in for Q2 at 1.66. Why is that important? Well, because that would be an expansion for 2 months. Remembering, a recession is 2 months of negative contraction. So when's the earliest we could confirm, again, if that number holds, when we're not sure it will, it's a preliminary number. We're only about 1 month into Q2. But if it holds for the next 60 days, what that tells me is that the market is going to take a move lower when it actually hears about recession. So in my opinion, if we're going to have a positive expansion for Q2, again, currently at 1.6%, anything above zero is a win, by the way. What does that mean? Well, it means the recession could only start in July. And when would it end? It would end in December. Why? Because it takes 6 months or 2 quarters of negative numbers, negative contraction, for us to confirm a recession. So the market usually bottoms before the recession, but at least for right now, maybe part of the move could be explained because positioning and people are just not really understanding that we're not going into recession at least quite yet. So 3 months could be a long time. It could be a short amount of time. And I actually want to take a moment here to just go through a couple of tweets that I laid out because I think that as we try to zoom out and understand things from a bird's eye view, things get a lot more simple. This is a chart that I shared on December 24th of last year. And I talked about how on a 12-month log scale, if we're green, we usually go green on the year. This was a warning at 38.44. We went green on the year, and now we're like a lot higher. That's the first one I want to go through. Second one I want to go through here is, where is it? Right here. So the slope of hope versus the wall of worry. But we want to look at it here relative to and if you want to follow me, my link's in the description. Here we go. QQQ on a 1-month chart. We note that as we were going lower, people are very hopeful. But now as we go higher, everyone's worried. So what do we do? Well, we keep just going higher. So as long as we keep forming monthly higher lows and monthly higher highs, which is what I just showed you on S&P, and if we look here to the NASDAQ or QQQ, this is really interesting because it actually managed into the close on Friday to close above the previous monthly high at 321.17. Not by a lot. It's by about $1.50, but we have that exact same pattern forming in here where we have 1, 2, 3 cuts. We have one pump, probably going to need 2 and 3 to fully retrace it. This is a monthly chart. It's going to play out very slow, but at least for right now, it's pretty accurate. So that's your bullish story. Now we're going to go through the bearish story at a very high level because I've already shared this as well. We're going to go here to the S&P 500 on a log scale. So we look here and see that, okay, well, this is about 6 more bars. And right now we're probably saying a lot of what it says right here. We have to just cool off before the next big rally. That is textbook complacency. And the last part about the bear story is that we're looking at potentially 6 months from the start of the SVB crisis for the big fade, meaning the next one. We're not sure what that's going to be. So in here, that was Bear Stearns collapsing in March. And then it took 6 more months for us to have the Lehman Brothers bankruptcy. So what does that mean? Well, oh my goodness. So March was what? Let's go to the S&P actually. Let's go to IET. Got the same thing as KRE, but March. Yes, in March. Ironically, the same month that we had that Bear Stearns collapse. So again, this is when Jim Cramer was really bullish on it, right? Nothing wrong over here with Lehman. But anyways, March of 2023 looks eerily similar to March of 2008. And if we extrapolate that out 6 months, that's a psychology chart I just showed you. And we also had FRC, or First Republic Bank, going into receivership on Friday. Why? The stock is a dumpster fire. So at least for right now, the 2 banks we were worried about were SVB and FRC. We're now through most of the earnings for banks, which means that at least for right now, things do not appear as bad as they did even only about a month ago. We can also see this here by going to the Fed's balance sheet. And again, it's clearly expanded, which means the numbers pointing up, the line chart's pointing up, but here's the SVB crisis. And every week it has printed a lower area, which means we're actually seeing banks stabilize. The Fed is taking their foot off the gas, and it looks a lot better than it did. So there we go. I think that pretty much summarizes both the bull and bear thesis on a monthly chart or a very high time frame. Cannot ignore, we're going to have the May meeting from the FOMC on May 3rd as well. And in addition to that, we have a few more really important data points coming out. Because I'm focusing on the whole month of May, I'm focusing on what can truly drive the market. So on Wednesday, May 3rd, we have the FOMC meeting. We have the interest rate decision. And then on Thursday, the next day, we have Apple earnings. And we also have the ECB coming in with their rate decision. That'll also be important. But again, we care about America, which means we care more about the Fed than we do the ECB. And then rounding out the week with Friday, we have it's called Payroll Friday. So we got the first Friday of the month coming in. We're going to get a look back to the month of April for non-farm payroll, unemployment rate. And this is what the Fed wanted to see. 180K jobs added, that's below 200,000, and unemployment actually ticking up by 0.1%. So if things come out, I think this would be interpreted as bullish. I have no idea what Jerome's going to do. Hawkish pause, dovish hike, hawkish hike. I have no idea. So I'm just prepared for high volatility. And lastly, we look here forward to May 10th. We have core CPI coming in. And why is that core CPI important? Well, I think I have the slide up right here. Here we go. Because we've been looking at two different ways to gauge inflation. The first one being core CPI, or consumer price index. This includes things like gasoline and food, like things you actually have to buy for a human being that's alive, but the Fed doesn't care about that. We note that since our peak at 9%, we've been forming lower highs almost every single month, other than one time where we formed a double top. It's been a straight line down. People have been really cheering on this number. The problem is when we look here, while CPI is showing that on a month over month, it's set to reaccelerate from 0.1 to 0.4. That is a bad number for us to look at if we're expecting inflation has already peaked. This is signaling reacceleration. And then on a headline number, or year over year, also expecting to go higher at 5.2. So what's so important to remember is that the Fed has told us they are willing to tolerate unemployment going as high as 4%. So if there's a pop on the 5th or payroll numbers, be prepared for it to fade on the 10th if these numbers also come in line. This is not going to be received well, in my opinion. The higher we go into that number, the more it's likely going to sting. And here's the reasons why. So I think Jerome is going to be focusing on core PCE. That is the personal consumption expenditures, I think is what it stands for. Correct me if I'm wrong by dropping me a comment. But this one here shows a lot more stubborn inflation. This is called services inflation, things like your wages. It does not include things like food and gasoline, and it's been going sideways. So like this is not good. This is what the Fed looks at. So if core PCE is going flat and there's the potential for core CPI to be heading higher, I think that maybe we're due for a little bit of a humbling. All right, so one more thing for us to look at here is going to be just positioning. So we look here to, this is a fund manager survey from Bank of America. Thank you, Mason, for sharing this. It tells us here that net percent overweight equities versus bonds is at the lowest levels that we've seen since 2020, 2009. And those are times when we were actually reversing to go higher. Is it a guarantee this time? I don't know, but things seem more rosy than they did before. Let's have a look here at the seasonality chart, because I want to focus in on the part where we stop going up, we go down, and then we have a sharp reversal all the way back up. Wouldn't it have been great to know? We look here at S&P that someone on YouTube would have told us that, hey, if we can stop going down, if we stop going up and we go down, we're looking for a violent move back up higher. Oh my God. I think there was a channel that talked about that. Maybe it was this one. If you do, remember, please make sure to smash that thumbs up. I would greatly appreciate it. So yes, this is not the Bible. It is not an exact, buy exactly here, sell exactly here. Exactly on May 20th, we buy. Exactly on June 5th, we sell. No, it's a template. It's a guide. It's a roadmap. And it told us that if we stop going up, well, we're going to go down. We went down in 2 cuts, 1, 2. We go down in 2 cuts. We have 1, 2, violent reversal, right back up to the relative high, which is exactly what we have here. Basically a double top, squeeze it higher a little bit more, then dump down. We are ahead of schedule, yes. But we also went up 7% into the first quarter, and normally we only go up by like 1%. So again, it's a guide, it's a roadmap. It is not a guarantee. So in terms of where we're going to go from here, if the seasonality chart is correct, well, I don't know. I think this was a great guide for us to get here. At a certain point, we have to just defer to the levels. So here we note that we got a low, higher low, higher low. So that's the monthly chart I just talked about. If we keep forming monthly higher lows and monthly higher highs, that's good enough for me right now, right here at this moment in the cycle. So if we look here to the S&P, the last thing I will note is that I believe, again, not I know, because I don't know everything. Here's what I believe. I believe that as long as we stay inside of these zones where we have these gaps, again, the saying is that most gaps get filled. It just takes time. So if we understand where these gaps come from, this is the gap that goes all the way back here to August of 2022. So we have a small gap here up to 421, or we have a gap down here to the downside that was formed in March of 2023, which would take us down to roughly 396. So we are closer to resistance. We could go back down to support, But until we either tag and fill the upper gap and then go higher, meaning above that bull market area at about 420, or we come crash lining down to 395, and then we're going lower again. That would also be a monthly lower low. That is going to be the signal for me. Until then, I believe we're going to be range bound, probably with higher lows and higher highs before we ultimately decide going into the next quarter in maybe 2 months to decide whether we are going into recession or maybe we are not. Looking here to the heat map year to date, we also note that there is a lot more breadth and depth to this market. Banks, they don't look terrible. You won't even know there's a banking crisis by looking here. Energy's doing okay. Tech is crushing it. Health is mixed. Consumer non-durables is mixed. So it's looking better. Is it fully operational 100%? No, that's what a rolling recession looks like. Some parts get hit harder than others. So let's look at a couple more quick charts here. S&P, we have a nearly a bullish engulfing pattern on the weekly. It's really strong. We've butted up against this area multiple times. Now we have to just actually claim it. And then if we look here to QQQ briefly, it's going to be a lot of the same things we just talked about on S&P. We note that we have math levels here. And I've laid out that line chart at the beginning of the show. So 1 cut, 2 cut, 3 cut. Well, that probably will lead to 1 pump, probably a back test, 2 pump, and probably 3 pump. If we're going to be perfectly symmetrical and this is the bottom. I just told you there's a lot of ifs. It means it's very conditional. But as of right now, we have a monthly, bullish engulfing monthly candle on SVB. And then we got a higher low, higher high. That looks bullish to me. We can also note the math number here that if QQQ is still leading the charge, it should advance here to 331, which is the 50% retracement the S&P is already at. It overshot to the downside, so it should also overshoot to the upside a bit. That's what I'm expecting as of right now. We can also note that, I don't know, this was back in March, I think even earlier. I think it was back in February. You can check our YouTube channel if you want to see that. We talked about a turning point. Well, we're pretty close to that 334, and at the time, no one wanted to believe it. So as we're getting closer to resistance, and QQQ is already in bull market territory by being above 305.12, we are really close, within 1% of getting to that 32697, or 20%. To make sure this is very clear, 305.12 means we're 20% off the low, but reclaiming 327 means that we are less than 20% off our high. That's a 20% correction from our high down to 327. So this looks like pretty good too. Support is lower, right? We can note it's lower, but until we're proven wrong, the turning point was a bullish one. And as we all know, things are bullish until they're not. So please make sure you're ready for the staircase down if that's going to be what happens. And if not, I thank you so much for watching. And if you want to watch more, the last weekend's video was probably the best one there. If not, thank you so much for watching. And I look forward to seeing you in June. Thanks so much.